Welcome to the Explainer. So here's the big question for you. Could you really use a simple checklist to analyze a company the same way one of the world's greatest investors does?
You know that feeling, right? You pull up a company's financial data and bam, it's just this wall of jargon. PE ratio, ROIC, EV/EBITDA. It can feel totally overwhelming.
So how do you cut through all that noise and get to a clear signal? Well, today we're going to do just that. We're going to take a real company, Analog Devices, and use a simple framework to see what story the numbers are really telling us. All right, let's get into it.
Okay, so here's our game plan. First, we'll do a quick Buffett-style checkup. Then, we'll dig into whether the business is truly wonderful. After that, we'll check how healthy the company is. Then comes the big one, the price. And finally, we'll pull it all together for a final scorecard.
All right, first up, a Buffett-style checkup. You know, Warren Buffett's whole philosophy can actually be boiled down to this really powerful three-step process. It's kind of beautiful in its simplicity, and it just cuts right through all that financial noise.
It's basically this. First, find a wonderful business. Second, check its financial health. And third, and this is key, buy it at a fair price. Simple, right? But so effective. So let's use that as our guide and start with step one. Is Analog Devices what you'd call a wonderful business? So what exactly is a wonderful business? Well, in short, it's a company that's consistently profitable. And a fantastic way to measure that is something called return on invested capital, or ROIC. Think of it like this. For every dollar the company puts into its business, how much cash does it get back? It's a great quality score.
Okay, so for APADI, that number is 7.40%. But what does that even mean? Is that good? Bad? Honestly, a single number on its own doesn't tell us much. We need some context here. Is this just a one-time thing, or is it part of a bigger trend?
And boom, here's our context. If you look at this, you can see that its current performance at 7.4% is actually better than its 3-year and 5-year averages. Now that's a positive sign. It shows things are not just good, they're getting better. So for our wonderful business test, I'd say that's a check mark.
Okay, so the business seems to be a quality one. But is it built on solid ground? I mean, a profitable business isn't so wonderful if it's drowning in debt, right? So let's take a look at its foundation, starting with debt levels.
The debt-to-equity ratio is 0.26. And the easiest way to think about this is like your own finances. It's how much debt you have compared to your net worth. You want that number to be low, and let me tell you, 0.26 is really low. That points to a super strong balance sheet, which is exactly what we want to see.
Okay, what else? Well, how about its commitment to its shareholders? A really good sign of a company's health is whether it consistently gives cash back to its owners through dividends. It's like the management team saying, hey, we're so confident about the future, we're willing to share the profits.
And get this, 23. That's how many years in a row Analog Devices has increased its dividend payment. 23 straight years. That is just incredible consistency. It shows real financial strength even when the economy gets rocky.
And check this out. It's not just that they're paying a dividend, they're growing it, and at a really healthy rate. Over the last year, it's up over 11%. So yeah, on the financial health front, ADI is looking rock solid.
All right, let's recap. ADI seems to check all the boxes so far, right? It looks like a high-quality, financially healthy business. But this all leads to the most important question of them all. Because even the most amazing company on the planet is a terrible investment if you pay too much for it.
So, let's talk price. First, what is the market asking for one share of this company right now?
$399.57. Okay, but remember, that's just the price tag the market has slapped on it today. That's what you pay. The real question is, what do you get? What is the business actually worth? What does a financial model, based on its real cash flows, say the fair value should be?
Right. So this is the number that's based on the actual performance of the business itself, not just the whims of the market.
$187.85. Whoa. Okay, that is a huge difference. And that massive gap between price and value, it brings us right to the heart of Warren Buffett's entire investment philosophy. It's this idea called the margin of safety. It's pretty simple, really. Buffett will only buy a stock if the price he pays is way below what he thinks the company is actually worth. That difference, that's his cushion. It protects him if he's wrong or if the company runs into trouble. So given our numbers, what's the margin of safety for ADI?
Yeah, it's negative 112%.
So the bottom line here is there isn't one. There is no margin of safety. In fact, this number tells us the stock isn't just a little expensive, it's trading at more than double its estimated fair value. Oof. All right, let's pull all this together and look at the final scorecard. How did ADI do on our Buffett checklist?
Okay, so let's break it down. Wonderful business? Yep, check. Strong and consistent? Financially healthy? Absolutely. Low debt? Great dividend history? Another check. But a fair price? That's a big red X. According to this data, it's just significantly overvalued. It fails that final and arguably most important test.
You know, there's that famous Buffett quote, "Price is what you pay, value is what you get." And that just perfectly sums up what we found here, doesn't it? The value of the business seems to be rock solid. But that price, well, that's a whole different story.
And that leaves us with one last big question. Our check today was all about the numbers, purely quantitative. But what about the things you can't easily measure? Things like brand power or amazing management, or maybe some game-changing new technology on the horizon. Could those qualitative factors be what's convincing the market to pay such a high price? Because the numbers tell a powerful story, but they don't always tell the whole story. Something to think about. Thanks for tuning in.